soft landing or no landing. Those seem to be synonymous now. Soft landing or no landing, just meaning we avert recession, we continue to grow at a healthy pace, inflation is under control, you name it. All the characteristics of a healthy environment is what the stocks are pricing in, what the bond market seems to be pricing in. Things went well last week. Now, it's not over. The big banks are not over. This is another big week for bank earnings. But they set the tone in the sense of, yes, we're seeing an uptick in some late payments, but it's not this alarming delinquency rate. And yes, consumers have pulled back on their spending, but again, not terribly alarming.
A very warm welcome to the Monday edition, and this is a special one, folks, of the On the Tape podcast. I'm Guy Adami. I'm always joined by Elizabeth Young Thomas of SoFi. EYT, how are you?
I am well. My Packers pulled it off again.
Well, of course you will. That's what I was going to say, because your Packers of Green Bay continue to play outstanding football in the NFC Norris division, which continues to be potentially the best division in football. We'll talk about that. But special because today Danny Moses is joining us. Demo, how are you?
Love to be with you guys on a Monday. What a bonus for me.
And a bit of housekeeping here, as they say. Thursday of this week, we will be live at the Robinhood Conference in Miami. We have an On the Tape that's going to open the show with Vinny Daniel and Porter Collins, which is going to be a lot of fun. And we're also going to do a live market call. That's this Thursday from the Robinhood Conference in Miami, Florida. So let's get right into it, Elizabeth. Obviously, a big day on Friday on the back of bank earnings, specifically JP Morgan. So the market took its cues. And today the market is further taking those cues as we see an S&P 500 at all-time highs, NASDAQ approaching, but we still have a VIX north of 20. But the market right now is saying full speed ahead. Thoughts?
Yeah, well, you know what's interesting about this environment? We've got stocks up, VIX up, yields up. And that is not usually the relationship that you see. And I talk about this all the time. I call it relationship problems because this is not typically a relationship that can persist for long periods of time. But right now, what I think everybody's reacting to is soft landing or no landing. Those seem to be synonymous now. Soft landing or no landing, just meaning we avert recession, we continue to grow at a healthy pace, inflation is under control, you name it. All the characteristics of a healthy environment is what the stocks are pricing in, what the bond market seems to be pricing in. And we know that as bank earnings begin, those big banks that set the tone for the rest of earnings season, things went well last week. Now, it's not over. The big banks are not over. This is another big week for bank earnings. But they set the tone in the sense of, yes, we're seeing an uptick in some late payments, but it's not this alarming delinquency rate. And yes, consumers have pulled back on their spending, but again, not terribly alarming. Now, you could look at that in one way, in a bullish way, and say, okay, things are coming back down to earth, right? People aren't spending money willy-nilly. They are maybe making their payments a little bit slower, but this is more of a normalization environment. Or you can look at that as the beginning of something worse. I don't think we have confirmation of that yet, but I would imagine that most cycles, if they get worse, start out this way. So we still don't know what's going to happen, but it is important to note some of those big banks, especially on the consumer side of the business, if they're not ringing alarm bells, the economy and other investors are going to take it as a positive sign.
Yeah, Dima, the Wall Street Journal actually had an article, soft landing or hard, ? And then they said bank results show path to no landing, which I continue to sort of scratch my head about. But, they're basically saying that, this environment suggests that things are sort of going to remain solid and we're going to sort of glide our way along. And this no landing economic scenario, I think, would be the first in my lifetime and maybe the first ever in terms of what we're trying to accomplish. But, I think Friday's JP Morgan specifically, and maybe to a certain extent Wells Fargo, suggests that. As Elizabeth said, we got Bank of America tomorrow, Goldman Sachs, Citigroup all tomorrow. And then Wednesday, we hear from Morgan Stanley. So, thoughts on sort of that whole no landing thing and what those bank earnings at least said to you?
So I go back to Thursday. CPI was a little bit hotter than had been expected, although inflation is still trending down. But right at the same time, you had jobless claims come out. And if you watch the market, it was telling you that I'm not worried about inflation. And guess what? If the economy does slow, I know the Fed has my back and the Fed's going to err on the side of being dovish here going forward. So that was my takeaway Thursday. Friday's takeaway, BlackRock to me was the big one. And people pretty much can telegraph flows. they had the highest quarterly flow in the history of the company. They're over 11.5 trillion in assets. So that's just supply and demand. And then JP Morgan and Wells Fargo, JP Morgan, as we know, the month before at a conference was kind of like a little bit cautious, potentially guiding down, and they beat that number. So all things being equal, if you meet or beat and exceed, I think it's still status quo. And I've been saying for a while, I think we've already passed the area of this landing, no landing, hard landing, soft landing. We've been pretty much done with the rate increase cycle now for a long time. And yeah, we're cutting here. So, but I think people need to realize you're always going to have a cycle. Like, don't be fearful of just something slowing. So every 6 or 7 years, maybe we get a recession. This is unlike any cycle in the history, obviously, of this economy because the amount of liquidity is still being pumped in. So I still think we're, kind of going between how much does the Fed have your back? Does it really matter? And one other thing I want to note, which is really hard for me to get comfort with, but the higher the deficit, which we've seen, we saw that news last week from the CBO about what it is, the more money is being pumped into the economy. So until people care about the debt, and it doesn't matter. So it's a liquidity chase here. So that's my takeaway.
So, Dimo, I'm going to stay with you for a second because a once very proud U.S. company has clearly fallen on hard times now. For the better part of the last 4 years, as we're sitting here, Boeing is making a new 52-week low of about 147 and change. It's amazing to me, but the fall of 2022, those lows of about 120 that we saw are right in the crosshairs right now. And on Friday, you talk about Friday night dirties all the time. Well, 17,000 people are going to be laid off for a number of different reasons. But, this strike is obviously not helping things. And Boeing, I only mention it not in terms of Boeing, the stock, but, potentially what it could mean, I don't know, to the U.S. and what the government may have to do to sort of prop this thing up. What are your thoughts on that?
Well, they have an audience of, 3, and that's the 3 rating agencies right now. And they're basically doing everything they can to stave off a downgrade, because if they go to junk status here, interest payments automatically trigger. We're talking the hundreds of millions of dollars. They're burning a ton of cash. So that's who that was for. But rarely do you see a company float a $10 billion any type of equity offering without it having already been placed. So I think they're trying to kind of zig and zag between, all right, where can we get an equity offering done? What will it take to convince equity investors we're on the right path? But Guy, you bring up a point. They're going to start cutting jobs. A big issue with this company has been safety and shortcuts and all this stuff. So, unless they're going to start to outsource more stuff, obviously, which has been the problem, I think, for the company from a quality control perspective, we have an issue. And I go back to the point where 40% of their business comes from the government. As a consumer, you want this company obviously doing the right thing and not taking shortcuts, which has been, I think, what happened to them. So this is a long way to play out, but I'll tell you that the debt is trading still well above not well above, but above junk status. And it's going to start to trade as a government entity soon enough if it gets worse. So the irony will be, I actually would own the bonds here before I would ever look at the equity, because I believe that it's going to be money good. They almost got bailed out during COVID. They used the implied guarantee from the government to go raise $25 billion in debt, then another $10 billion in debt. So here we sit with north of $55 billion or $60 billion in debt, and the company that's burning cash every quarter. So I stay away from the equity here, Guy, for what it's worth. But you're right, 170,000 employees. It's going to drop. Big, really important company to the U.S. So it's pretty important.
Elizabeth,
one of the things I have a quick question. One of the things that we talk about a lot, especially in the industrial space, when you look at the economy and there's indicators that you can watch, obviously economic indicators, but then there's bellwether companies. And this to me seems like an idiosyncratic event. It's Boeing specific, but is this something that could pose a risk to the industrial space in general, where there's always the first one to do it, the first one to execute on layoffs, and then everybody else feels like, okay, now I can, because there are reasons in some of the data, or there are reasons in the activity in the economy, and now I can follow suit. Do we think that this poses a risk to the rest of the companies in the industrials complex?
Danny, take a shot at that.
No, I don't think at all. I think this is very company specific. And they've obviously have major issues because of the halting in production of their products in general. So there's a gap here. So I don't see that in other industrial companies that are kind of out there. I think any industrial company that's dealing with labor issues potentially this is a warning that not that the strike necessarily caused these layoffs to happen on Friday, but I think you'll see companies maybe get ahead of any type of labor issues that might be occurring. And if anything, from a quality control perspective, if you do sell to the government, like Boeing does, I think it's a wake-up call also. But no, I don't I don't think it's really contagious here.
So, EY, I'm going to come to you now because it was the spring of this year when we saw 10-year yields sort of peak. And then obviously things started to move lower in terms of yields, higher in terms of the TLT, which is something that we look at just in terms of, giving you a good indicator as to where things are going, right? So the TLT, interestingly enough, topped out at, or yields were at their lowest at September 16th, right when the Fed cut 50 basis points. Since then, the TLT has basically been a straight line lower. So from 101.5 down to about 93 or so, which doesn't sound like a big deal, but it's taken 10-year yields up to about 4.1%. So it's interesting to me that bond volatility is seemingly back. The yield curve, which steepened, flattened, and now is steepening again, but it's steepening with yields going higher. There's a lot of things to be concerned about, I think. But I think the optimist is saying, you know what, Guy, you're looking at it incorrectly. Yields are going higher because the economy's on stable footing. Thoughts on the bond market here?
So if the yield curve is steepening because yields are going higher, that would be a bear steepener for bonds. So I just want to clarify too, because when we talk about the TLT going higher or lower, we're talking about the price of the TLT, not the yields. So what's happened in the last few weeks is you've seen yields rise. We've got a 10-year now at about 410. The uninversion now at a spread of somewhere between 14, 15 basis points. We haven't quite gotten much above that, but Guy, as you and I have talked about so many times, it's not the inversion that gets you, it's the re-steepening. And I think about this pretty often. It's how the re-steepening occurs. And what was happening, which is what I expected before, was more of a bull steepener. So you've got short yields coming down as we expect the Fed to continue cutting rates. And then we get some of this hotter or so-called hotter economic data, rate cut expectations come in too. A couple of things I would say about this. There has to be somewhere for volatility to go. Investors are not certain yet what's going to happen with the Fed and what's going to happen with the economy and inflation and jobs. And if the volatility isn't showing up as we would expect in the equity market, despite the fact that the VIX is up, it still feels like the equity market just goes up no matter what. If it's not showing up there, it needs somewhere to go. It is going to the bond markets. And what's happening in the bond market right now is these swings again, and we've talked about this many times, swings in treasury yields and movement in treasury yields that shouldn't be happening at that size and magnitude, and they shouldn't be happening at that velocity either. So I would tread lightly in the treasury market. But the other thing I would say is with the yields up as much as they are, in the last few weeks, this feels like an overdone action to me. This feels overdone. I think that this is the market trying to price in, we're in a good place, growth is going to continue to rip. And if there's any margin for error, we're not finding it, particularly in the bond market. So any little bit of data that comes in cooler than we're expecting, you're going to see volatility in the other direction in bonds. And I would be really careful about that. The last thing I would say is when you look at the expectations for Fed cuts, that swings pretty wildly too. And right now, we're not even sure that we're expecting 2 by the end of the year, but that changes on a dime. We get one bad jobs report and that's going to fly up again. So don't get married to where the Fed cut expectations are on any given day, and don't get married to where bond yields are on any given day.
Yeah, Danny, I want to sort of point out, obviously, today's Columbus Day, so the bond market is not trading, but TLT does trade. So you can sort of still gauge where yields are going or where yields are based on that. With that said, the other reason I think yields have been going higher is because we saw some hot data last week in form of the CPI and the PPI, which I think, I don't want to say was disappointing, but probably surprised people. And there are now people talking about potentially this reacceleration of inflation. So, thoughts on the bond market volatility and why you don't think the equity market is really paying attention right now?
So longer end of the curve yields have obviously moved higher, but credit spreads haven't widened. If anything, they've tightened. So that's something that I certainly watch. And then I think it's really the absolute level of 10-year yields where they go versus what we're trying to figure out an inversion or a steepening, what might be going on. So we can kind of play around in this 375 to kind of 440 or 450 level. But we've all seen in the last few years, there's a level where the yields themselves will start to have an impact actually on the fundamentals of companies and people that need to borrow. So I think we're kind of in this zone here where it's still okay. So that's something I'm paying attention to. And it's not an unhealthy, if you just showed this in a flash in a moment of where the 2 and the 10 was right now, relative to where it was maybe a year ago or so, you would say, wow, things must be okay. And I think that's just the status of it. Things are okay. But I do think that I am surprised by how tight credit spreads have been. The demand for ABS products, asset-backed securities that are kind of out there for anything. So people are craving still this yield with a sign of no recession still here. I think that's going to be the status quo. So I'm more, attuned to the absolute level of the yields right now versus kind of the curve itself.
No, fair enough. And we'll see. Stan Druckenmiller, I think, was speaking last week or a week and a half or so ago. And I think right now, 15 to 20% of his portfolio, Elizabeth, is short bonds, which suggests he thinks rates are going higher. And his concern is some of the issuance is coming and some of obviously the debt problem that, again, the equity market is looking past. But he also said that he was actually embarrassed that his portfolio was not shorter bonds. So we'll see. But one thing that I think that came on the back of was commentary around what's going on in China. We had David Tepper talking about buying everything that's not nailed down. We've obviously seen some incredible volatility in the Chinese markets over the last week and a half, but they had a bit of an underwhelming, I guess, press conference over the weekend. Thoughts on this whole China trade? Because you correctly pointed out that it was probably going to do it back and fill. We're seeing it. I will say I don't think the equity portion of this is over, but it's clear they're concerned about their markets, I think, more than they are about their economy. Thoughts on that?
Well, they are more concerned with their markets than their economy, but their economy is driven more by their corporate sector than compared to ours, where we're driven more by the consumer. So if they're trying to target the thing that might give them the most bang for their buck, I suppose they did it in the right way initially by targeting the corporate sector. However, propping up stocks is not something that fixes the economy. So what happened in the initial days after that stimulus is stocks got propped up. It worked. If that's what they were looking to do, it absolutely worked. But what they needed to do was come in and announce more stimulus, or at least a willingness to stimulate in other parts of the economy that are actually holding inflation down and keeping it in this deflationary spiral. So there was a study, I've mentioned this a number of times now, by Goldman, saying that they only really spent about half as much as they need to get the property market back into a more inflationary or healthy spot. They need to announce more stimulus on the property market. At least that's my expectation. And that was my hope for what happened over the weekend. They talked about a willingness, perhaps, or something that could happen in the future. I think what investors were looking for, what everybody was looking for, was something more specific with a dollar amount and exactly how they might do it. And that's not what happened. So now we're still sitting in limbo with, I do think they will stimulate more, but when, how big, and what's it going to look like is still a question mark.
Danny, thoughts on that? And I'll just throw this sort of nugget in as well. I mean, the China-Taiwan situation seemingly continues to sort of ramp up. We saw some things over the weekend that's actually catching the attention of the major news networks. I saw it on all the different networks, including CNBC earlier this morning. Again, market seems impervious right now, but there's a lot going on the Chinese front. So thoughts on those things?
Yeah, so core CPI came out for September. It was up 0.1%. That's the lowest reading since two other times, GFC and COVID, just to put it in perspective. Liz's point about what can you do to target really consumption and helping the consumer, that's not what's going on right now. But I do believe that they'll do a Mario Draghi thing from years ago, whatever it takes, or whatever the phrase was that he said. So they're going to keep coming. The Chinese market in general is really not trading that expensive relative to its history on a PE basis. I don't know the exact, somewhere between 10 and 11. That's kind of like the 5-year average, I think, is what it has been. But I think your point is a good one, Guy. It's not just about the stock market there. It's about politics there. And you've always said, and not joking about this at all, but one way to cure your unemployment rate in China is to go to war with somebody. And that wouldn't be the reason. But the point is that I think you're making is that there are other issues here affecting China. They've already done all the technical things they can with the stock market, short bans, making people buy stock. Like, they're doing all the things they can. I think maybe just to present a prettier picture that there are kind of things here are fine, things here are fine. So I'm not playing in that market right now, but I do think, Guy, you're right. I think the politics take precedence over kind of the economy at the moment, and certainly something to watch, at least from a global stock market perspective.
But all those things lead, seemingly everything we've talked about for the last 20 minutes or so, all paths lead to the gold market, which Elizabeth continues to perform. It's something you've talked about for quite some time. Obviously, Danny has as well. And what I find really interesting, EYT is that gold's been going up with rates going lower. Gold's been going up with rates going higher. Obviously, the dollar has impact as well. Gold seemingly sort of shrugging its shoulders to all those factors and just continuing it on its merry way. So what are your thoughts here? I mean, I think you're going to say stay the course. I think you're right to say that. But, you know, what is the gold market seemingly telling people that they're not listening to?
Well, and full disclosure, and I've mentioned this before, I have not changed my gold positions in a while now. I did trim some earlier in the year because it felt like 25% up in gold was a good gain. So I took some winnings, but I still own GLD, I own PHYS, and I own the miners as well. I have not changed, but I also have not added. I'm just kind of letting them run. And we talked about last week a big pullback in the miners. And just a reminder, when you're looking at gold mining stocks, those are actual stocks. Those are actual companies. They're going to participate in stock market volatility more than maybe the commodity or spot price of gold will. But I still think there's room here. And I wrote about gold a couple weeks ago because of the big run it's had. And that I think there's a lot of investors not realizing that gold has outperformed the S&P year to date. It's outperformed it on a trailing 1-year basis, outperformed on a trailing 3-year basis. And that's not normal. So something is going on. A lot of what has been going on is that China's central bank has been purchasing gold. And I talked about that in the piece about making sure that they have reserves that are not in the form of US dollars. So that's understandable to some degree. I still think there's room. I think a big driver of it has been an expectation for extended currency volatility around the globe. But I imagine that there's got to be some buyers out there also worried about US debt and the deficit. And I don't think that's the majority of buyers yet, particularly because you're not seeing it show up in retail trades. If and when the retail buyer comes into gold in a big way, that's when I might start trimming because you don't want that to get in an overbought position. But I think there are a couple different drivers. And then there's got to be some sort of force that's just kind of a head scratcher. Why does it continue to rise if everything is good? Gold is a traditionally defensive asset.
Demo, I look at the GDX, the VanEck Gold Miners ETF, and since March of this year, it's made a series of higher highs and higher lows. And in order to continue that trend, and we're sort of on the uptrend again, you know, we need to sort of get above 42 in the GDX. We're trading either side of $40 right now. So the gold mining stocks have not been as straight a line as the underlying commodity for a myriad of different reasons. But I would still submit in this environment with, as Liz said, the PHYS, the Sprott Physical Gold ETF, making an all-time high, the gold mining stocks are seemingly underperforming in this environment. So what are your thoughts on gold and the miners as well?
So the miners trade actually more on energy prices because they pay a lot of money to get the stuff out of the ground. And so when you look at oil prices relative to miners, you see a perfect correlation. So that's why you've seen this kind of catch up as oil kind of pulled its way in from the mid 80s to kind of the high 60s. That's why I believe miners started to outperform. As it relates to gold, every pullback has been shallow. And even the pullbacks you would think when there's hotter economic data and the dollar strengthens, that gold should come off, it's coming off $20 or $30. A year ago, 2 years ago, we'd see a $70 to $120 drop in gold per ounce. We're not seeing that anymore. So it feels like every drop is a buying opportunity. And of course, Liz is right. When you get a run in anything like that, if you start buying something and it's 100% higher than it was, you have double the position that you had. So if you're getting near your target, the same way, short should be covered, the same way long should be sold into it. That's a good risk mitigation strategy. But I'm so long and strong, and I don't see anything going on in the markets that would tell me that gold's going to come off at all. And there are no sellers, and retail does not own it yet. You still don't have that ownership yet. Yes, they're selling bars at Costco. Yes, you're hearing more and more, but it's not in the mainstream yet. And so I'm long and strong on the gold.
This week, a bunch of economic data, Elizabeth. We have some Fed speak. I think Neil Kashkari is speaking a couple times this week. Austin Goolsbee as well. Waller's speaking. The typical weekly, daily Fed speak that we're seeing. But there are also a number of different earnings that I think are interesting. I'm not going to ask you to opine on individual stocks. As I mentioned, we have Bank of America tomorrow, Goldman Sachs, Citigroup. But I think Friday is interesting to me because we're hearing from American Express. And again, no need to opine on the stock, but what they potentially could say in terms of delinquency rates. And what I'll tell you is right now, the average rate on a U.S. credit card is about 23%, a little bit higher than that. I think U.S. credit card debt is now $1.35 trillion. And And I think most important, delinquency rates are north of 7%, which is the highest we've seen since 2011. So are we going to learn anything, do you think, from the American Express quarter and then subsequent guidance?
Well, so a couple of things. When you look at companies like Bank of America, more exposed to the consumer side, so you want to listen up to what they have to say. American Express, as we know, it serves a different credit card customer. So it's a higher end customer. I wouldn't expect that we're going to hear a bunch about delinquency rates being very concerning from a company like Amex. Later in earnings season, when you hear from other companies, Capital One is one that is a good indicator of this, that is lending to a more middle or lower end consumer. That's where you want to listen up. Now, the thing about delinquency rates is they have been rising. They were concerning. Actually, earlier this year, they were rising at a faster clip. They haven't gotten to a point, and Danny, you would know the numbers better than I probably. They haven't gotten to a point where back in the GFC, we were looking at delinquency rates that skyrocketed. And that's now people's sort of high watermark for that's when the problems begin. And since we're nowhere near that, we're looking at these delinquency rates and saying everything's fine. But it's the trajectory of it. It's the fact that they have ticked up and the consumer that is under pressure. And I think there are a lot of synchronicities between the consumer that's under pressure on delinquency rates and then looking at companies that are the trade down companies. And we've talked about this a lot, the trade downs to Dollar Tree and Dollar General and those companies suffering. So there's clear issues on the lower end of the income range and even on parts of the middle end of the income range. But it's been masked by a lot of the spending that still occurs on the upper end. So you have to think about these companies as what kind of consumer do they serve? What is that consumer buying? And what is their spending power? And there are a lot of differences among credit card companies for that.
Yeah, thoughts on that, Danny? By the way, great use of synchronicity, a marginal at best Police album, Danny, but I digress.
I love that album. But it's funny you mentioned synchronicity because Synchrony is going to be reporting this week, I think on Wednesday. They are the private label credit card company for like retail. When you go into a store and they issue you a card, that's normally Synchrony. So that's something to watch, I think, kind of on the middle to lower end. You also have Discover, which I know they're merging with Capital One. At some point, they're going to close. And to Liz's point, Capital One is kind of middle. Discover is certainly on the lower end. So those are two that I would watch kind of for the health. And the other thing that seems to get lost, and I've been wrong on the stock recently, is Affirm. And the buy now, pay later sector in general, which is more than just Affirm, has extended the growth or allowed consumers, I think, to extend kind of their credit to a degree. And I don't think that's being appreciated enough of the impact that it's having. And even if it's the impact of 0.5% in terms of delinquencies or staving those things off, I think it's worth noting. So the growth has been explosive in that category. So something to watch there, but credit in general seems to be okay. JP Morgan took a pretty sizable reserve in their credit card portfolio last week. People maybe paid attention to it, maybe not enough. But Liz is right. It's the consumer-facing banks, the Wells, the Bank of America, the Cap ones that matter. American Express is obviously it's not going to have an issue with delinquencies. They're going to tell you more about how the high-end client is doing. And I will tell you that we're seeing more and more studies that are coming out. The stock market and the wealth effect it's having on the higher-end consumer is real. And so just keep that in mind. If you ever did get a turn in the stock market, I think you would see a direct hit, I think, to credit companies in general.
You know, real quick before we get out of here, and Elizabeth, you sort of talked about it earlier, but you know, if you would have told me the S&P 500 on this Columbus Day was making an all-time high, again, Dow Jones right there, NASDAQ pushing up against it, and then said, okay, guy, where's the VIX? I would have said low teens because historically that's sort of what we'd sort of gravitate down towards. Yet here we are, either side of 20, which you know, may not be a warning sign at all. I still go back to that August 5th day when you saw that huge spike in the VIX. I said it then, I said it now. I think that was sort of a warning shot, and I think it was a bit of a tremor. I do think there's more volatility ahead, but you know, the equity market, seemingly at least today, is divorcing itself from VIX that's either side of 20. Quick thoughts on that.
Yeah, well, we talked about the August 5th incident as you don't usually see those as one and done. So there are likely to be other spikes. The thing about volatility is that it's usually just a spike. It happens very quickly. It comes back down very quickly, especially in a market like this where we've got all this buy the dip mentality and that big tech saves us in up, down, sideways in any environment you can name. So I think one of the ways that we'll probably hear this VIX move explained away is that if we're normalizing everything, we also have to normalize the VIX. And a VIX somewhere between 10 and 13 was abnormally low. And we've talked about this before. if you want to normalize the economy, you have to normalize a lot of other things with it. You have to normalize stock multiples, you have to normalize bond yields, you have to normalize the VIX. And perhaps right now, this can be looked at as a normalizing phase. But it is interesting that it's not getting a ton of attention, because I remember a time, a months-long time, when 20 was what we watched on the VIX, and it was this big hurdle to jump over, and it was an indicator that we were in some sort of new regime. Yet we haven't really heard much from anybody about being concerned about the VIX being over 20 for a while now.
Demo, before we sort of 5,000, thoughts on the volatility index, if any?
Yeah, so I think NVIDIA, just to take a step back, kind of stabilizing and regrouping and moving its way back higher has been a big positive for the markets in general. I will say that the bull bear index, however you want to gauge it, AAII, whatever you want to use, is a pretty good indicator that we're due for some type of mini correction, sell-off. You can't have this type of sentiment occurring. And it is rare to see this type of volatility increase without any type of pullback in the market. And I'll tell you that we're seeing a lot of call option activity. We saw it on NVIDIA. This call buyer came back last week. David Bull put that out from Baycrest last week, something to watch. So I still think, again, you can have higher vol. It's going to cost you more in premium in the option market to protect at that moment. But at some point, we're just going to have, somewhat of a healthy maybe sell-off. So be aware of sentiment that's kind of out there. So yes, I am paying attention to volatility. And I haven't seen a real spike in volatility without some form of a sell-off in the market. I think that's very rare not to see. So let's see what happens.